challenge that we've noticed is with potential partners or buyers or customers. I can almost remember back to November 2008, things stopped. A lot of the companies that were either in discussions with customers or were in discussions with potential buyers, they all stopped. When the financial crisis hit, a lot of them just said, well, we have to stop because we have our own issues, or the first knee-jerk reaction was we want to see what's happening. And so a lot of the discussions that were happening, stopped, and they basically said, well, come back to us when things kind of settle down. So you had to stop, and then now people are starting to be re-engaged. But for an early stage company that's doesn't have a lot of cash, stopping for 12 months is not not ideal. And in a lot of cases, I mean, there's still some deals done that are done at good premiums, but for the most part, it's a buyer's market, and the buyers know it. There's lots of inventory of technology on the market, lots of inventory of products. So, and certainly in the med tech, we saw this in a number of sort of our med tech or medical equipment companies, where the U.S. hospitals back in November of 2008 just froze. They froze their budgets, and that's a long sales cycle to begin with. And so we had to stop in a lot of cases, and then they've started to be re-engaged again. But it was a challenge for a lot of these companies. Cash management, that's always a challenge. Good times are bad, but in this particular case, it's been very challenging. I like to think a lot of the companies have survived the crisis, but I'm not sure the crisis is over, and so you've survived, you're still having difficulty raising money. And that's meant a lot of companies are starting to cut corners, which is not a good thing. It's good to focus, and be capital efficient, but now they're getting to the point where they're cutting corners. And like Peter said earlier, if you don't have a company that doesn't got a very good broad data package, or it hasn't done things the right way, it shows up, and it shows up when you start to talk to people, potential buyers or potential partners. So it's starting to, by cutting corners, because you don't have enough cash, it's starting to impact, it'll impact them down the road. Again, because you're managing cash, there's no room for errors. It's essentially impossible to change directions because no one, your existing group can't fund it. And then when you're cash poor, you delay hiring key staff, so you're not getting the people you need to do the job. And in some cases, you have to go and partner earlier than you wanted to, and those deals aren't exactly optimal. So it's, and all this is kind of, at least I've seen in a number of cases, really put a lot of stress on management and motivation. So it's really hard on the management teams. Some of them are starting to lose staff as people kind of filter to other industries. And another thing that we think is so critical, and again Peter mentioned it earlier, was lack of alignment. We typically want to go into deals where everyone's aligned, management's aligned with the shareholders, and all the shareholders are aligned. But now we're into an environment where the shareholders are starting to break their alignment, and some, for whatever, they're late in their funds and they have to sell, and other investors want to stay on, and that's creating a whole new problem for these companies. So just change the view a bit. So what are the challenges as an investor looking at new deals? Certainly as an investor, the biggest challenge is just poor returns, which is causing a problem for the whole industry. And the returns are the result of just few exits. There are some deals being done, but not a lot of M&A, and certainly in Canada, not that IPOs were an exit, but it was at least one step towards exiting in the public markets. And certainly, if this industry is going to survive, we need to get more exits on a more consistent basis, or else it's going to be difficult to grow the industry. Perhaps one of the I kind of view maybe one of the benefits of not having a big exit market is there's starting to be a more focus on building companies, as opposed to, I don't hear the phrase, let's invest and we'll flip it in 2 years, or let's invest and we'll sell it in a couple of years. The focus now is, when we look at companies, we need to build a company that is a standalone company, and then certainly if we have the opportunity to sell at some point, we will, but the focus is now back on building companies. As with most VCs, they want to syndicate, because there's fewer investors around. Syndication is taking a lot longer to do, and plus with fewer investors, the finding overlap of interest is more challenging as well, because not all investors or institutions focus in the exact same area, and in Canada it's even harder. So that whole process is taking long, and we're moving to a lot of funds are simply saying, I don't want to invest in a company unless all the money is around the table on day one. So there's no more of this, let's do an investment, we'll raise enough money, hit some milestones, in 2 years' time we'll do another round, bring in a new group, and then in another 2 years we'll do the same thing. It's now everybody around the table at day one, that we have enough money to take the company from where we are to a real key event, whether it's in therapeutics, good phase 2 data, or in sort of all the other industries, enough to be cash flow positive. And then it's always a challenge of, because when we go into an early stage company, we're not only trying to satisfy ourselves, we're looking at what do we need to attract the late stage groups. So what do we need to, if we're doing a therapeutics company, and so what do we need to do, or what does this company have to look like that will also attract Peter's fund, in 2 or 3 or 4 years' time. So we're also, that's always a challenge, trying to figure out where they are and where will they be in 3 or 4 years' time. A big challenge for us now, I think, are hold periods. We used to think that we would hold companies for 3 to 7 years. For the seed and early stage, I don't think it's unrealistic to start to think that we're going to be holding these companies for 7 to 12 years. In fact, our portfolio is already up into the 8, on average 8 years. And we have a few that are close to 10 years now. And because you're holding them long, this is a volatile business, so you're going to go through more and more cycles of ups and downs, which will be a challenge in itself. Key issue, and this management this has always been a challenge. Certainly in seed, you always want at least to have one business person who's done it, and then the challenge is, can we believe we can build a team where they're located?